The recent move in the silver market marks a defining moment that investors have been anticipating for years. Silver has decisively broken through the $75 price level, a barrier that had acted as an impenetrable ceiling for nearly 3 years. This was not a brief spike or a fleeting test of resistance. It was a powerful confirmed breakout. The market did not merely touch $75 and retreat. Instead, silver surged beyond it and closed the week at approximately $75.60, finishing at the very top of its trading range. From a technical perspective, this is one of the strongest signals a market can deliver. For years, the $75 level represented the line in the sand. Every previous rally stalled there as selling pressure reliably overwhelmed buyers. This repeated failure conditioned market participants to believe that $75 was an absolute ceiling. As a result, skepticism became entrenched, and confidence in sustained upside was repeatedly crushed. The fact that silver has now broken through this level and held above it into the weekly close fundamentally changes that narrative. Closing at the highs is particularly significant. It indicates that buyers were not afraid to hold positions over the weekend despite volatility and headline risk. Instead of rushing to take profits, market participants demonstrated conviction, signaling that demand remained stronger than supply even at elevated prices. In technical analysis, such a close often marks the transition from a consolidation phase into a trending phase, where price behavior accelerates and expectations reset. Equally important is the psychological shift this breakout creates. Resistance levels that cap price for years tend to become powerful support once broken. What was once viewed as an upper limit is now redefined as a floor. This role reversal alters trader behavior as dips toward the former resistance are increasingly seen as buying opportunities rather than warning signs. In historical market cycles, breakouts from multi-year bases are rarely subtle. They often initiate moves that extend far beyond what most participants expect, precisely because so many were positioned for failure. The breach of $75 is not simply another price increase. It is a structural change in the silver market. It signals that the long period of suppression and disbelief may be over, and that silver has entered a new phase where higher prices are no longer exceptional, but normal. The explosive move in silver was not driven by emotion or speculation alone. It was the direct result of a structural failure within the banking and options market. For months, and in many cases, years, large commercial banks and market makers positioned themselves on the assumption that silver would remain capped below the $75 level. They reinforced this belief by building massive short positions in the futures market and by selling large volumes of call options at the $75 strike price. As long as silver traded below that threshold, these positions generated steady profits and appeared relatively safe. That illusion collapsed the moment silver pushed decisively above $75. Once the price crossed this level, the options sold by banks suddenly moved in the money, transforming what had been manageable risk into immediate exposure. At that point, market makers were no longer in control of the price. They were subject to it. Option sellers are obligated to hedge their risk, and when prices move sharply against them, this hedging becomes automatic and non-negotiable. The mechanism that drove the surge higher is known as a gamma squeeze. As silver rose above $75, bank algorithms were forced to buy silver futures to hedge their options exposure. Each incremental rise in price increased the urgency of that hedging, which required even more buying. This created a feedback loop in which rising prices triggered additional forced purchases, pushing prices higher still. Crucially, this buying was driven by mathematical necessity rather than market sentiment or bullish conviction. The timing made the situation even more severe. The breakout occurred during a holiday period marked by thin trading volume and reduced liquidity. With fewer natural sellers in the market, the forced buying from algorithms had nowhere to go. As a result, prices gapped higher in rapid succession as the market searched for available liquidity. In effect, the very institutions that had spent years suppressing silver's price became unwilling participants in the rally they sought to prevent. Their trading systems were compelled to buy aggressively at rising prices, turning former sellers into desperate buyers. This inversion of roles exposed a fundamental weakness in the paper market. When too much risk is concentrated at a single price level, the system becomes unstable. What unfolded was not a loss of confidence, but a loss of control. The bank's strategies depended on silver staying below a fixed boundary. Once that boundary failed, the structure collapsed under its own weight, unleashing a rapid and violent repricing that reflected the true imbalance between paper positions and available supply. The timing of silver's breakout makes the move even more significant. The surge occurred during a holiday trading period often referred to as Ghost Week, when global financial markets typically experience thin liquidity. During these periods, major trading desks in London and New York operate with reduced staff volumes, decline, and price movements are usually easier to control. Historically, large banks have used these low-volume environments to push prices lower, exploiting the lack of resistance to paint bearish charts and weaken investor sentiment ahead of the new year. This time, however, the usual playbook failed. Instead of a price smash, the market experienced a melt-up. The key reason was simple: physical demand did not disappear for the holidays. While many financial traders stepped away from their desks, real-world buyers remained active. Industrial consumers, particularly in Asia, continued to source silver for manufacturing needs. Sovereign and institutional buyers stayed engaged, and informed retail investors recognized the opportunity presented by thin liquidity. In an environment where supply is limited, thin liquidity works both ways. With fewer sell orders available, even modest buying pressure can move prices sharply higher. Physical buyers understood this dynamic. Rather than viewing low-volume conditions as a risk, they saw them as an opening. With senior risk managers and key decision-makers away from trading desks, the usual resistance mechanisms were absent. Demand encountered little opposition, allowing prices to rise rapidly. This imbalance between persistent demand and reduced market depth created ideal conditions for an upside acceleration. Buyers were willing to hold positions through the weekend, signaling confidence rather than fear. The weekly close at the highest point of the range confirmed that demand was not speculative or fleeting. It was structural. In technical terms, such a close indicates that buyers were in control throughout the entire session and were unwilling to relinquish gains. The episode highlights a critical distinction between paper trading and physical reality. Paper markets can pause for holidays, but physical supply chains do not. Factories still require metal. Long-term accumulators continue to buy, and global demand does not take time off. When these forces collide with reduced liquidity, prices must adjust upward to restore balance. Rather than suppressing the market, thin liquidity amplified the underlying shortage. The breakout revealed that when physical demand remains constant and paper sellers step aside, price no longer reflects manipulation or sentiment, it reflects necessity. This shift underscores why the move was not an anomaly, but a signal of deeper structural stress within the silver market. The rapid surge in silver has placed short sellers in an increasingly precarious position, creating what can best be described as a classic short seller trap. Many traders and institutions had entered short positions at significantly lower prices, often between $72 and $74, confident that silver would once again fail near its long-standing resistance. That assumption proved costly. As the price vaulted past $75 and held its gains, these short positions immediately moved deep into loss territory. The timing of this move intensified the pressure. With markets closing for the weekend, short sellers were forced to carry their losing positions through a 48-hour period, with no ability to react. This is more than a financial inconvenience. It is a psychological strain. During the closure, global news continues to flow overseas. Markets prepare to open, and uncertainty compounds. Short sellers are left to contemplate the risk of a higher open, a gap up in Asian trading, or an unexpected geopolitical event that could send prices sharply higher before they have a chance to respond. This scenario fundamentally changes market dynamics. When trading resumes, short sellers no longer think in terms of maximizing profit. Their focus narrows to damage control. The primary objective becomes exiting positions at the first reasonable opportunity. This shift in behavior introduces a powerful and persistent source of demand-forced buying. Every price dip becomes a potential exit point for shorts seeking relief, which in turn creates a natural support level beneath the market. This phenomenon helps explain why bull markets often display remarkable resilience. Unlike rallies driven purely by optimism, a short squeeze embeds its own safety mechanism. As long as short interest remains elevated, downside moves are met with immediate buying pressure from traders attempting to cover. This dynamic reduces the likelihood of sustained declines and keeps volatility skewed to the upside. Moreover, the longer prices remain elevated, the worse conditions become for those still holding short positions. Margin requirements, increased losses accumulate, and risk managers grow less tolerant. Eventually, even the most stubborn participants are forced to capitulate. That final wave of covering often produces sharp, accelerated price moves. In the case of silver, the break above $75 transformed a comfortable trade into a high-risk liability. The market effectively locked shorts into a waiting game they cannot win. Each hour spent above the breakout level strengthens the trap tightening pressure and reinforcing the upward bias that now defines the market. A critical force driving silver higher is the growing price divergence between Western paper markets and the physical market in China, particularly as reflected in Shanghai pricing. For an extended period, silver has been trading at materially higher prices in Shanghai than in New York, creating a persistent arbitrage gap. While Western markets hovered in the low 70s, Shanghai prices approached and at times neared the $80 level. This discrepancy was not merely theoretical. It represented a tangible imbalance in global supply and demand. Such gaps cannot persist indefinitely in a globally traded physical commodity. When one market consistently offers higher prices, metal flows toward that market. Silver began moving east at an accelerating pace, drawn by stronger bids and more reliable physical settlement. As this outflow intensified, pressure mounted on Western exchanges, particularly in New York, where inventories were already strained. The longer prices remained suppressed in the U.S., the faster physical supply drained away. The recent move to approximately $75.60 in New York should be understood not as speculative excess, but as a corrective adjustment. The U.S. market was forced to raise its bid to slow the exodus of metal and reestablish balance. This process reflects a fundamental truth of commodities. Markets' physical demand ultimately dictates price. Paper contracts can delay that reality, but they cannot override it indefinitely. Even after the sharp rally, the price gap has not fully closed. With Shanghai still trading near $80, the U.S. market remains several dollars lower. This residual spread acts like a magnet, exerting upward pressure on Western prices until parity is restored. Traders and physical buyers alike recognize that as long as the U.S. remains the cheapest source of silver, buying will continue and inventories will remain under pressure. Importantly, this dynamic reframes how price levels should be interpreted. What appears expensive when viewed in isolation may still be undervalued in a global context. Relative to Asian physical pricing, silver in the U.S. remains discounted, not overheated. This challenges conventional overbought arguments and reinforces the idea that the rally is grounded in structural forces rather than momentum alone. The Shanghai price magnet illustrates the limits of price suppression in a connected world. When regional imbalances grow too large, arbitrage becomes unavoidable. The recent breakout signals that this corrective process is underway, and until prices converge, the gravitational pull from Asia will continue to draw silver higher in Western markets. While the paper price of silver has captured headlines, the more revealing story is unfolding in the physical market, where conditions are becoming increasingly strained. Reports from major bullion dealers indicate that inventories are critically low, and the traditional dynamics of retail silver sales have broken down. Rather than offering holiday discounts or promotional sales, dealers are doing the opposite. They are raising premiums and widening spreads. This unusual behavior reflects not greed, but risk management in a market where replacement supply is uncertain. The core issue is simple. When a dealer sells a physical ounce of silver, they must be confident they can replenish that inventory. Under normal circumstances, wholesalers, refiners, and mints provide a steady flow of metal. During the holiday period, however, many of these upstream suppliers are closed or operating at reduced capacity. At the same time, demand has not slowed. Dealers face the possibility that silver prices could gap sharply higher before they are able to restock, turning today's sales into immediate losses. To protect themselves, dealers have adjusted pricing to reflect this risk. Although the quoted spot price may sit near $75, the actual cost to acquire physical silver is far higher. In many cases, the ask price for coins and bars is approaching or exceeding $90 per ounce. This widening gap between spot and physical pricing signals severe stress in the supply chain and undermines the reliability of paper price benchmarks. This disconnect highlights a critical flaw in the way silver is priced. The spot price is increasingly detached from real-world conditions, functioning more like a delayed or distorted indicator than a true measure of value. In practical terms, it resembles a broken thermometer. It may display a number, but it no longer reflects the actual temperature of the market. Physical buyers are already operating in a higher price environment, even if futures markets have yet to fully adjust. As physical availability tightens, the pressure on paper markets intensifies. If physical silver cannot be sourced at the quoted spot price, arbitrage mechanisms break down and confidence in paper settlement weakens. Eventually, one of two outcomes must occur. Either physical premiums collapse through a sudden influx of supply, or the paper price rises sharply to match reality. Current conditions suggest the latter. The physical market is not merely tight, it is approaching exhaustion. This breakdown indicates that the recent price surge is not speculative excess, but a delayed response to scarcity. As physical constraints continue to assert themselves, the paper market will be forced to reconcile with a world where silver is priced not by contracts, but by availability. As the calendar approaches, year-end institutional behavior becomes a powerful and often underestimated force in financial markets. In the case of silver, this timing could not be more significant. Silver has emerged as one of the strongest performing assets of the year, and its decisive breakout above long-term resistance places it squarely in the spotlight. For institutional investors, this creates a reputational and professional dilemma that often leads to a surge of late-stage buying. December is effectively report card season in the financial world. Hedge funds, mutual funds, and pension managers must prepare year-end statements for clients detailing both performance and asset allocation. These documents are scrutinized closely, not only for returns, but for whether managers identified and participated in major market trends. When a standout performer like silver appears on the scoreboard and a fund has no exposure, the absence is glaring. This dynamic triggers a behavior known as window dressing. Fund managers, motivated less by valuation and more by optics, begin purchasing assets that have already performed well simply to show ownership on December 31st. The goal is not necessarily to maximize returns, but to avoid the appearance of incompetence or neglect. In this context, silver becomes a defensive buy for institutions that ignored it earlier in the year. The impact of this behavior is amplified by the scale at which institutions operate. Unlike retail investors, funds do not buy in small increments. They acquire large positions, often in a short time frame, and they tend to be price insensitive when urgency is high. This creates sudden, powerful bursts of demand that can overwhelm normal market flows, especially during a period of reduced liquidity. Beyond year-end reporting, this institutional scramble sets the stage for the January effect. Once silver appears on balance sheets, it becomes easier for managers to justify expanding positions in the new year. Pension funds and long-term allocators often rebalance at the start of January, and strong year-end performance can act as a catalyst for sustained inflows. Importantly, this demand is not driven by changes in fundamentals. It is driven by human behavior, career risk, and fear of missing out. Yet the market does not distinguish between vanity buying and conviction buying. Both push prices higher. In silver's case, institutional FOMO adds a powerful tailwind at a critical moment, reinforcing momentum and increasing the likelihood that the breakout extends well beyond year-end. The surge in silver prices has dramatically altered the economics of silver mining, yet equity markets have not fully reflected this transformation. At prices near $75 per ounce, most primary silver producers are generating extraordinary cash flow. For many established miners, the all-in cost of producing an ounce of silver ranges between $20 and $25. This means that at current prices, miners are capturing margins of $50 or more per ounce levels that rival or exceed those of some of the most profitable technology companies. Despite this, silver mining stocks have not risen in proportion to the metal itself. This disconnect represents a significant opportunity. Historically, mining equities tend to lag during the early stages of a metal's breakout. Investors often focus first on the commodity price, while skepticism toward mining due to past cycles, operational risks, or environmental concerns keeps generalist capital on the sidelines. As a result, mining stocks frequently remain undervalued, even as their underlying profitability improves dramatically. The gap, however, cannot persist indefinitely. Mining companies ultimately report earnings, not narratives. As quarterly results are released, particularly in the upcoming reporting cycle, the financial impact of higher silver prices will become impossible to ignore. Record revenues, expanding margins, increased free cash flow, and the potential for higher dividends or aggressive share buybacks will force a reevaluation of the sector. When these figures hit financial statements, investor perception often shifts rapidly. Another factor contributing to the lag is that many institutional investors still associate mining with capital-intensive, low-return businesses. That perception changes quickly when cash generation becomes visible. At sustained prices above $75 balance sheets, strengthened debt is reduced, and growth projects can be funded internally rather than through dilution. This fundamentally alters the risk profile of mining companies. Once recognition sets in, mining stocks tend to move swiftly. Because their valuations are based on future cash flows, even small increases in expected metal prices can lead to outsized equity gains. This creates leverage to the underlying metal price that physical silver cannot provide. While holding physical silver preserves purchasing power, mining equities offer the potential to multiply it. In this context, the current underperformance of mining stocks is not a warning sign, it is a signal. It suggests that the market has yet to fully digest the implications of higher silver prices. For investors who understand the math, the lagging response of mining equities represents a window of opportunity that may close quickly once earnings and capital returns bring reality into focus. Silver's recent surge cannot be understood in isolation from the broader macroeconomic and geopolitical landscape. What makes the current move especially significant is that silver is not merely rising against the US dollar. It is appreciating across virtually all major currencies. It is gaining ground against the euro, the yen, and other fiat units, signaling that this is not a localized currency story, but a global reassessment of monetary value. This broad-based strength points to a deeper loss of confidence in paper currencies as a whole. At the core of this shift is the growing strain within the global financial system. Governments around the world are burdened by historic levels of debt, and the primary response has been continued monetary expansion. As currencies are diluted to service obligations, their purchasing power erodes. Investors, institutions, and even sovereign actors are responding by reallocating toward assets that cannot be created at will. In this environment, precious metals, particularly silver and gold, are regaining relevance as monetary assets rather than mere commodities. Geopolitics further amplifies this trend. Nations within the BRICS bloc, including China, Russia, and India, hold substantial physical metal reserves and have been steadily increasing their exposure to hard assets. As silver prices rise, their balance sheets strengthen relative to countries more heavily dependent on fiat issuance. This dynamic represents a subtle but meaningful transfer of financial power, reinforcing the strategic value of physical commodities. Speculation around future trade and settlement systems adds another layer of complexity. There are growing discussions, particularly in Asia, about the possibility of resource-backed trade mechanisms emerging in the coming years. While such developments remain uncertain, even the perception that metals could play a larger role in global settlement elevates their strategic premium. In such a framework, silver is no longer priced solely as an industrial input. It begins to function as a monetary asset with geopolitical relevance. Historically, when silver has served a monetary role, its purchasing power far exceeded modern price levels. In past systems, an ounce of silver represented meaningful labor value and real economic exchange. Today's prices reflect decades of monetary suppression and industrial classification. The recent breakout suggests that markets are beginning to price in a shift toward silver's monetary characteristics. Viewed through this lens, silver's rally is not speculative excess, but an early adjustment to structural change. As geopolitical fragmentation accelerates and trust in fiat systems weakens, the demand for tangible, universally recognized stores of value grows. Silver's strength reflects this transition, positioning it at the intersection of monetary evolution and global power realignment. Major market breakouts are rarely comfortable, and silver's current advance is a textbook example of the psychological challenges that emerge during a supercycle. When an asset breaks out from a multi-year consolidation, traditional signals that investors rely on often lose their effectiveness. Indicators such as overbought conditions, elevated RSI readings, or steep price angles normally suggest caution. In a supercycle, however, these signals frequently remain extreme for extended periods, frustrating those who attempt to trade against the trend. The reason lies in the nature of long-term structural shifts. When price escapes a base that has confined it for years, the market enters a new regime. Supply and demand dynamics reset, and participants must reprice expectations. What previously looked expensive quickly becomes normal, while attempts to fade the move result in repeated losses. In this phase, the market is not responding to short-term sentiment, but to a broader revaluation process. Psychologically, this creates discomfort. Vertical price movements trigger fear of a crash, even as fundamentals improve. Investors are conditioned to expect mean reversion, so rapid gains feel unsustainable. Yet supercycles often advance precisely because so many participants remain skeptical. As prices rise, doubters are gradually forced to re-enter at higher levels, providing additional fuel for the trend. Another defining feature of a supercycle is the failure of pullbacks to deliver lasting relief. Corrections tend to be brief and shallow, often stopping at former resistance levels that have turned into support. This reinforces the bullish structure and shifts behavior. Instead of selling rallies, participants begin buying dips, further strengthening momentum. Retail psychology evolves alongside price. At lower levels, investors are dismissive or doubtful. As the asset moves higher, curiosity replaces skepticism. Eventually, confidence gives way to fear of missing out, drawing in a broader audience. This transition from disbelief to participation is not a sign of weakness. It is a hallmark of powerful trends. Attempting to short an asset in this phase is particularly dangerous. Betting on a reversal because the price looks high ignores the context of structural change. In a supercycle, speed is not a warning, it is a feature. The market accelerates precisely because it is repricing an asset that was undervalued for an extended period. Understanding this psychology is essential. Success in a supercycle depends less on perfect timing and more on disciplined patience and the ability to tolerate volatility without abandoning the underlying thesis. As silver enters the final trading days of the year, the market is approaching a critical inflection point that will help define the trajectory of the next phase of the bull cycle. The immediate roadmap is shaped by a combination of technical structure, calendar effects, and market psychology. Having closed at the highs near 75.60, silver has set the stage for continued volatility with a strong bias toward further upside. The first key event lies in the market reopening. Because silver closed at the top of its weekly range, there is a heightened probability of a gap higher when trading resumes, particularly as Asian markets respond first. Participants in those markets often attempt to front-run anticipated moves in Western trading, which can push prices sharply higher before North American investors are even active. This dynamic increases the risk of being sidelined for those attempting to time pullbacks. Following any initial surge, the market may experience a short-term retracement. Such pullbacks are normal and even healthy after a breakout of this magnitude. The critical level to watch is the former resistance zone around $75. A controlled dip toward this area, followed by a strong rebound, would confirm that the breakout is structurally sound. In technical terms, this retest transforms resistance into support and reinforces the bullish trend. Midweek becomes increasingly important as year-end approaches. A decisive close above $75 at the end of the year would send a powerful signal to institutional investors, many of whom rely on annual charts and closing prices to guide allocation decisions. Such a close would frame silver as a dominant asset entering the new year, increasing the likelihood of sustained inflows in January. Psychological milestones also play a role in the roadmap. With little meaningful resistance between $75 and $80 price action may accelerate as it approaches the next round number target. These levels often act as magnets in momentum-driven markets, particularly when sellers are scarce. A move toward $80 would not simply be technical. It would elevate silver into mainstream awareness, expanding participation and volatility. Overall, the roadmap ahead suggests a sequence of gap risk consolidation and potential acceleration. While short-term swings are inevitable, the structure favors higher prices as long as silver remains above its breakout zone. For investors, the focus shifts from predicting each move to managing exposure within a rapidly evolving trend. As silver advances into higher price territory, managing volatility becomes just as important as understanding fundamentals. One of the most common mistakes investors make during strong trends is failing to recalibrate their expectations for price movement. At lower price levels, daily fluctuations feel manageable. As prices rise, however, those same percentage moves translate into much larger dollar swings, creating the illusion of instability even when the underlying trend remains intact. This shift can be psychologically disorienting. A 1% move at $20 is barely noticeable, but at $80 it represents nearly $1. A routine 5% correction, which is normal in any healthy bull market, suddenly becomes a $4 decline. Without proper perspective, these moves can trigger emotional reactions that lead to poor decisions such as panic selling or overtrading. Market participants with short-term agendas often exploit this effect. Large intraday swings are frequently used as a tool to unsettle less disciplined holders. Headlines amplify the drama by emphasizing absolute dollar moves while ignoring broader context. A sudden silver plunges $4 narrative sounds alarming, even if the metal has risen $20 over the previous week. This selective framing is designed to shake confidence, not to convey meaningful information. Discipline requires focusing on structure rather than noise. In a sustained uptrend, the key indicators are higher highs and higher lows, not day-to-day volatility. As long as this pattern remains intact, pullbacks should be viewed as part of the market's natural rhythm rather than signs of failure. Emotional responses to short-term fluctuations often result in selling at precisely the wrong moment. Another important aspect of discipline is resisting the urge to constantly monitor price movements. Frequent checking reinforces anxiety and magnifies perceived risk. Instead, setting predefined alert levels at meaningful price zones allows investors to stay informed without becoming consumed by every tick. This approach helps maintain objectivity and reduces the temptation to react impulsively. Ultimately, volatility is not evidence of weakness in a strong market. It is a byproduct of momentum and participation. As more capital enters, price discovery becomes more dynamic. Successful investors accept volatility as the cost of participation in a powerful trend. They understand that the goal is not to capture every minor move, but to remain positioned through the broader cycle. In this environment, discipline is the true edge. Those who maintain perspective, manage emotions, and respect the trend are far more likely to benefit from silver's advance than those who allow short-term turbulence to dictate long-term decisions. As silver prices rise sharply, the conversation naturally shifts from accumulation to preservation. Wealth creation is only the first step. Protecting that wealth becomes the greater challenge. When silver traded at lower prices, holding a meaningful quantity of physical metal posed little concern. Its value was modest. Its bulk made theft inconvenient, and few people paid attention. That reality changes quickly as prices climb towards $7,500 and beyond. What was once an overlooked asset begins to resemble a high-value target. This transition requires a change in mindset. Physical silver should no longer be treated casually or discussed openly. Visibility becomes a liability. Publicly sharing ownership details, posting photos online, or casually mentioning holdings to acquaintances increases personal risk. As economic pressures rise and inflation erodes purchasing power, desperation grows. In such an environment, discretion is a form of security. Remaining inconspicuous, appearing ordinary and financially unremarkable, reduces exposure to unwanted attention. Storage considerations also evolve as value increases. Silver's density and volume present unique challenges. A position that was once manageable in a basic safe may exceed insurance limits without the owner realizing it. Many homeowner insurance policies offer minimal coverage for bullion or cash equivalents, often capped at very low amounts. As the value of stored silver multiplies, these limits can leave holders dangerously underinsured. Upgrading security infrastructure becomes essential. High-quality safes rated for burglary resistance, thoughtful concealment, and layered security measures are no longer optional. For larger holdings, professional vaulting solutions may offer a superior balance of safety and peace of mind. Private depositories provide insured storage-controlled access and physical security that far exceeds what most individuals can reasonably implement at home. While such services involve ongoing costs, they are best viewed as protection against catastrophic loss rather than an expense. Wealth management also extends to psychological discipline. Rapid appreciation can trigger anxiety, compulsive price checking, and emotional decision-making. Constantly recalculating net worth amplifies stress and undermines judgment. Long-term holders benefit from shifting focus away from daily valuation and toward strategic objectives. The true value of physical silver lies in ownership and control, not in moment-to-moment price fluctuations. Ultimately, rising silver prices demand professionalization. As wealth grows, so must the systems that protect it. Security, discretion, insurance, and emotional discipline become integral parts of the investment strategy. In a volatile world, preserving hard-earned gains is as important as achieving them, and preparation ensures that financial success does not become a personal vulnerability. The current move in silver represents far more than a short-term rally or a speculative surge. It signals a structural transformation in how the metal is valued. For decades, silver has been treated primarily as an industrial commodity, its price constrained by paper markets and sustained suppression. That framework is now breaking down. Silver is increasingly being recognized as a scarce monetary asset, and the shift in perception is driving a repricing that may unfold over years rather than weeks. Multiple forces are converging to support this transition. On the supply side, silver faces a persistent and growing deficit. Mining output has struggled to keep pace with demand, and much of the available metal is consumed in industrial processes rather than recycled. At the same time, inventories across major exchanges and private vaults are thinning, leaving little buffer against rising demand. Scarcity is no longer theoretical. It is observable. Demand dynamics are equally compelling. Industrial usage continues to expand, particularly in energy, electronics, and advanced manufacturing, while investment demand is accelerating as confidence in fiat currencies erodes. Governments worldwide are responding to debt pressures with monetary expansion, undermining purchasing power and driving capital toward tangible stores of value. In this environment, silver's dual role as both industrial input and monetary metal gives it unique leverage. Market structure adds another layer of pressure. Large short positions, derivative exposure, and mispricing between paper contracts and physical markets have created instability. As these imbalances unwind, price discovery becomes more volatile and more honest. Each attempt to suppress price now carries greater risk, increasing the likelihood of sudden discontinuous moves. Historically, when silver has transitioned from commodity to money, its valuation expanded dramatically. In prior monetary systems, silver represented real labor and purchasing power, not marginal industrial cost. Modern pricing reflects decades of financialization rather than intrinsic value. The recent breakout suggests that this disconnect is beginning to close. From a big-picture perspective, silver is emerging at the intersection of supply scarcity, industrial necessity, monetary debasement, and geopolitical realignment. These forces do not resolve quickly. They build pressure until repricing becomes unavoidable. While timing remains uncertain, the direction is increasingly clear. This is why the current phase matters. It may mark the early chapters of the most significant commodities bull market since the 1970s. For those positioned early, the opportunity is not merely to profit from volatility, but to participate in a broader revaluation of real assets in a world where trust in paper systems continues